Hello everyone, I am Raghav Goyal. I am an ACC affiliate currently working at KPMG as an audit associate. I am also a three-time world rank holder and an India rank holder in subjects such as FR, tax, and advanced tax. I always wanted to teach students as I felt that I have a lot to offer, and it made a lot of sense for me to start with audit itself as I am currently working as an audit associate. So I would like to, share my knowledge and experience with regards to audit and assurance field. So when it comes to the ACCA AA exam, let's get started about the introduction and how this paper is structured. So as you may be aware that this paper is different than the other skill level papers in its structure. For example, FR, FM, tax, PM, these subjects have 60 marks of MCQs and 40 marks of subjective section C questions, but that's not the case with audit. We have 30 marks MCQs and section B comprises of subjective answers of various areas such as planning and risk assessment, internal control, and substantive procedures. So it's a different paper, not something which you will have encountered during your skills level journey. It is a paper which is better if given after FR, as the financial reporting standards and frameworks are important in building your base for the audit. Apart from that, the portion itself is not very lengthy. As I'll show you, the portion consists of 12 chapters itself. So you can expect to be done with your chapters, by April end or even mid of April. These 12 chapters. The first four basically are tested in your MCQs, that is section A for 30 marks. Then these are the chapters which are tested for your section B 70 mark questions. So even in 70 mark, we have a split of 30, 20, 20, with each question comprising of several sub questions. For example, of 7 marks, 8 marks, 5 marks, like that. That we will see later in the exam kit. So chapters such as risk, planning, evidence, systems and controls, procedures, reporting, all are very important. The plus side of this portion being less is that it doesn't require a lot of studying time, but it requires a lot of practice time. So with that, we can move ahead. Speaking about the syllabus areas, we have the syllabus split into 4 to 5 different areas, such as audit framework and regulation, which comprises of, what audit means, what external audit is, why it is required, the frameworks which the auditors have to follow, the ethical considerations that they have to consider. For example, the auditor cannot do things on their own. There is a set standard procedure, SOP, which the auditors have to follow. There are guidelines and a lot of things which the auditors need to take care of while working on their engagements. We will be looking at them in deep. Then we have corporate governance. Basically, you know, for example, if you have audited a client, then you cannot go and get employment at the client place. There are restrictions on that. So, for example, you have worked at KPMG, then you cannot go and work with their clients. That is not the case only for KPMG. It's a standard, restriction that everyone has to comply with. Then we have various ethical considerations. As an ACCA professional, we are bound to act in the best interests of the society as a whole. We have to adhere to principles such as integrity, objectivity, professional competence, and due care. Then we also have to maintain confidentiality, which means that we cannot leak the client information to others for our benefit or for any other person's benefit. We are trusted with that information and we need to protect it. Then we also have certain planning and risk assessment procedures which we need to follow. So you can't just, you know, sign the audit report just like that and do the procedures without any planning. So the first important step would be planning and risk assessment of the entity you're auditing. With planning, what you have to do is basically resourcing the teams that you'll be needing, the amount of time that you'll need to perform the procedures, test the controls, everything like that. Then also the risk assessment of the entity. For example, the entity which you are auditing could be exposed to more fraudulent activities. So if you accept that engagement, there is a chance that the risk you face will also increase, and you have to assess whether that risk is acceptable for you as an auditor. So after the planning and risk assessment stage, once we are, uh, happy with our decisions, with our planning, we start executing those plans by understanding the entity, the financial reporting framework, the standards, the policies they use, the industry data. Then we also look at the fraud laws and regulations that the company has to follow and whether they are following them or not. Then we have internal control, which is quite important. So larger entities have a lot of internal controls in place. And as an auditor, it's not possible for you to audit each and every transaction in its detail. So you test the internal controls, and if they are working and you have enough evidence that these internal controls are reliable and they are working in a way which they are intended for, then you can place reliance on these internal controls and your substantive procedures will then be reduced. You won't need to test the full population because that may not be possible in case of larger entities which, let's say, take and make 1 lakh transactions every day. So in that case, it won't be possible for you to do a full substantive testing. That time, internal control is very important. Then we have more on internal audit, the function of external and internal audit linked together, the scope of the internal audit, how it can be incorporated in the entity. After that, we have audit evidence to support our findings. You can, print this one word, one phrase in your brain about evidence. That evidence should be sufficient and appropriate. What do you mean by sufficient? Sufficient means, by its basic sense, having enough of it, and appropriate means it should be relevant for the thing you have collected the evidence for. It should be it should be sufficient and appropriate. For example, quality and quantity. Quality means the appropriateness and quantity is the sufficiency. Then once we perform audit procedures such as substantive testing, there could be various substantive procedures that we perform. For example, checking the cash books. Casting means checking the totals whether they have been correct. Reconciling the bank statements to the entity's cash books. anything such as that, it comes under audit procedure. Then we have audit sampling and other means of testing. So when you have to audit a few transactions out of a large population, how do you choose those samples? There should be a logic behind that. There are random methods and then there are specific ones. So for example, if an area is certainly riskier, then you would ensure that you chose that sample first and then you went on to random sampling. So these are some of the methods that we will be looking at. Apart from that, there are certain procedures for account balances which are, inherently risky. So for example, receivables, you can perform whether it ties to revenue, it balances properly in the purchase, in the sales books. Then with inventory, you can perform valuation checks whether the value that is recorded in the financial statements is correct or not. And you can also perform cutoff testing. So, for example, what do you mean by cutoff testing? There is a chance that the entity has sold inventory before the inventory has been sold after the year end, but it has been written off in the current year itself to show it as a sale. So that's not quite right. And you have to ensure that it is being recorded in the correct period. So these are some of the examples that I could think of. We will be looking at, each one of them in detail. Then there are work of others, internal audit specialists who value things and other considerations as well. So the auditor will need to, ensure that the work performed by these external parties is reliable so that, there is no hesitation in giving an audit opinion based on their work. Then there are a few different audit techniques for not-for-profit organizations, as the profit is not the main focus. Their main goal is to see that whether they have fulfilled the value for money criteria. There it could be efficiency, effectiveness, and economic value. Then at the end of the day, once you're done with all your procedures, if there are no misstatements or anything such as that, found, then you give your audit opinion, whether it's a qualified opinion or an unqualified opinion based on the procedures you have performed. Then you do the final things of audit, such as the documentation bits and obtaining documents from the management as well. This is how the audit syllabus looks like. It's interesting if you look at it step by step. It's a completely theory paper and there's not much of numbers in here. So if you're someone who's into theory, you'll likely enjoy this paper. But if you are someone who likes practical things, then it might be a bit of a stretch for you, as you may just have to read things. And let me tell you that the audit taught in this paper is good for foundation, but it's not exactly how audit is done in the real world. It's it's the concepts are right, but in the practical world it's different. You won't be performing each and every part yourself. For example, as you're a fresher, you may be working more on substantive procedures rather than risk assessment, but it's good to have an idea about everything. So here we have the section A, which will be of 30 marks. Then we'll have section B of 70 marks with three questions of 30, 20, 20. We'll have a look at it later when we reach there. We will also be looking at ACCA Study Hub for our MCQ practice. The Kaplan study text and exam kit is good enough. If you do it twice, that will help you a lot to gain confidence and answer the questions rightly. I think minimum two should be a good number. If you can do it thrice, it's even better. But I would suggest you to do it at least twice. One more thing about this paper is that you don't need to rote learn the definitions as such. You should be able to understand them and write it in your own words. That's completely fine. ACCA does not expect you to fully write things from the study text itself. So let's begin with our first chapter, Introduction to Assurance. It's a small chapter which will be done in this recording itself. So what is assurance? In its simplest terms, we can say assurance is basically assuring someone, giving someone confidence, giving someone the surety. So in the context of audit and assurance, what does it mean? It basically means giving assurance over the subject matter that this is correct and this is true and fair, so that the person who will be using that subject matter can make informed decisions and place reliability over your opinion on that subject matter. So what do I mean by subject matter is that in the context of audit, it will be our financial statements. So once we have tested the numbers and everything, that yes, it's true and fair, there are no material misstatements, then the shareholder can place his confidence in the financial statement and he can make the decision whether to invest or to do anything. Even stakeholders such as the government, banks, loan lenders, and the general public, they care about a lot. So if you ask me how they are concerned with the financial statements, is that the government would be interested in knowing the tax that the entity is paying. Then the general public would be concerned with how the entity manages its CSR, corporate social responsibility, whether they, you know, do their activities in a sustainable manner, not harm the environment that much. Then shareholders will, of course, be interested in the financials mostly, and loan lenders will be, interested in the credit worthiness of the company, whether the company is in a good position to repay its debt obligations. So, yeah, don't worry about anything. We'll be looking at all of these things in detail one by one when it comes in our way. It's just a brief idea. So, if you read this thing, you won't understand much. But in my terms, I would say assurance basically means giving an opinion about something for which the information once given, the person can make confident decisions about it. For example, if I was to give you an unaudited financial statement, but at the same time I gave you an audited financial statement. In the unaudited one, there is a good amount of profit, but in the audited one, it's slightly below par, and the auditor also has performed various substantive procedures and has given a proper unqualified opinion. Then what do you think? Where do you think you will place your reliance? With the unaudited one, there is no one who has checked the financial statements. It's the management that they have published these and they think that it's true and fair. So, where do you think the chance of fraud by management is more? The audited one or the unaudited one? That's right. I'm pretty sure you must have come up with the fraud being more possible in the unaudited one. Why? Because there was no one to check. When there is no one to check your work, you have an incentive to manipulate the numbers. For example, if you were to be left in a vault with camera shut down, no security, it is full of cash, then there is incentive for you to steal something, right? Even if you do not, if you do or do not, that's up to your ethical and moral principles, but there is incentive for you. There is a strong incentive for you to do it. But at the same time, if the security itself is jam-packed, everything is reviewed, there is a higher chance of you being caught, then your incentive will definitely drop, and so will the motivation. So it's similar in that sense. So basically, the risk of information being incorrect is reduced because of audit and assurance. So there are basically five elements of an assurance engagement which you need to be worried about. Sometimes these are tested in the MCQs. We have three parties. So if I was to put it in a simple manner, three parties. One is the auditor, one is the client, and third is the public that will be using the reports that we make on the client. So practitioner is the auditor, review of the subject matter, who provides the assurance. Then we have the intended users for whom we are making the report, for whom we are assuring. So this would be the stakeholders, shareholders, governments, banks, anything. Then we have the responsible party, which is the client itself. He is responsible for the numbers, the financial statements, and this is the management of the company we are auditing. Then we have appropriate subject matter. So when it comes to audit, the subject matter is the financial statements, but there are assurance engagements where you could provide assurance over things other than financial statements itself. So that's why it's appropriate subject matter. This will be something which will be examined by the practitioner, which is us, the auditors. Then we have suitable criteria. What do you mean by suitable criteria? So when it comes to financial statements, I'm pretty sure you can think about things such as the IFRS, the IAS, the other, standards that the company will apply. So the criteria will be whether these policies and standards have been applied correctly, whether the laws and regulations have been followed. Then we have sufficient and appropriate evidence. As you can see, that's what they have written here. We need sufficient and appropriate evidence to provide our opinion. We cannot provide opinion based on half-cooked evidences. It needs to be clear and, pretty strong. Then after everything is done, our written assurance report comes out, which expresses the opinion about the subject matter, which in our case will be the financial statements. So, for example, they have separated in relation to an audit and to a forecast. Audit is for financial statements, and forecast is something you will be doing later on. It's a report for the future, so you can't really audit it as it is not historical, but you can assure the users of this forecast that the basis which has been used to prepare this is reliable and you can place your assurance on it. So similarly, the practitioner is auditor, assurance provider, users here will be shareholders for the financial statements. Here it's usually used by the internal management itself. The responsible party to provide the information correctly would be the directors, that is the management of the client itself. Then we have appropriate subject matter. In our case, it's financial statements. It could be forecast as well. Then the criteria for financial statements would be the reporting framework, which includes, GAAP, generally accepted accounting principles, then IAS, IFRS, anything which the company adheres to. Then similarly with regards to forecasts, we would have to check whether the assumptions are correct and based on something strong and concrete. Then we have to perform certain audit procedures such as tests of control, substantive procedures. Similarly, here also we will be performing those procedures. Once we have enough evidence, then the written report comes, providing whether the financial statements give a true and fair view. And with regards to an assurance engagement, the report says whether anything has come in light which suggests that the assumptions are not on a reasonable basis, then they will include that in their report if they find something. Otherwise, they won't need to say anything. Let's look at a small example which will help us understand and link more. So let's say you're buying a house and you know nothing about houses as such, but you are interested in buying an expensive house and it's a very big financial decision for you. So it's better to consult an expert who knows about that house, about its structure, about its, foundations. It should not fall, within a year or anything like that. Then any other thing which could come to his notice, it's likely that he'll spot out something which we will completely miss. So once you consult him, he has a look at it, he tests a few things, and then tells you and gives you a report that yes, this house is okay to live in. These are the problem areas. And then based on that report, you can make your financial decision. If you think that no, that this building is too risky for me, it requires more work, and I cannot buy it in this condition, then you may not choose buy, and then you may not buy it. But at the same time, if you feel like, okay, it's not a lot of work, it's in a good condition, it is valuable at this point of time, then you will go ahead and buy it based on that expert's report. If we were to take that expert's report out, then you would be confused and would most likely make an uninformed decision, which means that you would just be making it for the sake of making it without any, analysis or anything else. So, in a similar way, we have the auditor for the financial reports. The auditor is basically like a doctor of the financial statements. He will have a look at it, see what's wrong with it, and tell the management that all this is wrong. You should have it corrected. The management will take the necessary actions, and then the auditor can say, yes, they have done so, and these financial statements are now reliable and they represent their true picture. So based on that, once the auditor says that, then you are the shareholder of that company. And if you feel like, okay, that the results are true and fair, they are in line with my expectations, then you will make decisions whether to, let's say, invest more, or if you find that no, don't see the future in this company based on these financials, then you could sell your shares. But to be able to place reliance in those financial statements, it is important to audit them. So if anyone asks you why auditing is important, you can simply refer to my example of a bank vault, that if there is no security, then there is more incentive to cheat and manipulate and defraud. But once the security is tightened, the money of investors is safe. So that's how we'll be, doing this paper. It's more of speaking and not reading it exactly from the book itself. Looking at a few assurance engagements, they could include audit of FS, review of FS, testing of internal controls. Then there are a few principles that the assurance provider will have to follow, that is complying with ethical requirements. For example, you cannot leak client information to others. You are in a position which is very privileged to receive the client information and have it before anyone else. You cannot misuse it. So that's one ethical thing you need to be you know considerate about. Then you have to use your professional skepticism and judgment. This is something which you will hear a lot in the audit paper and even in the professional level papers going ahead. What is professional skepticism? I'll give you a minute to maybe grab a few thoughts about it. So basically, professional skepticism, put in the simplest of terms, is not accepting things at face value. So let's say, referring back to our old house example, let's say the expert says that this house will stand for the next 150 years. Would you stand there and just say, okay, or would you question him? You would ask him, right, that why do you think it will not fall for the next 150 years? So once he presents a rationale for his thinking, then you can consider whether, yes, that's right or wrong. So that's what skepticism means. Not accepting things at face value, having a questioning mind, that you need to be, proactive and always be thinking about things. If the management has used assumptions in their, statements or anything anywhere, then you can question those assumptions. Like, why are they based on that? What is the base point of that assumption? There is a high chance that the points on which the assumption is based could be completely wrong. For example, they are taking market value of inventory to be lower than their cost. The net realizable value is less than the cost, then they would have to record it at that. But there is a chance that it's higher than the cost itself. So we would need to analyze that further. So this is what skepticism is. We need to be questioning, but it doesn't mean that you just each and everything. You also need to be professional about it. Use your own judgment on matters where skepticism is required. Then we also have acceptance and continuance procedures to ensure only work of acceptable risk is accepted. So what does this mean? This basically means that, let's say, if a certain company is risky because they've had a history of fraud and errors in financial statements, and now you were to audit them, being associated with that company, it increases your risk as an auditor. You could lose your reputation, you could face fines and penalties, and that risk could be a lot. It could be more than you're willing to accept. So you have to assess that as well before taking on a client. At the same time, you agree the terms of engagement with the management so that there is clear communication and there's no miscommunication as such. Then you have to adhere to quality management standards. Then we plan and perform the engagements effectively, obtaining sufficient and appropriate evidence. After that, we our work is not done just at the reporting date. There are usually subsequent events after the reporting date which could, affect the financial statements, and thus your audit opinion could also be influenced by that event. So those things also need to be considered. Then we have types of assurance engagement. So looking at the different types of assurance engagements, we have reasonable assurance engagements and limited assurance engagements. What do we mean by reasonable ones? Reasonable ones is where the extent of procedures performed is slightly higher. So substantive procedures have been performed, test of controls have been done, and then the report is given of the auditor's opinion. But limited assurance is when the extent of procedures is not that high, fewer things are tested and performed, and the level of assurance is lower. So looking at the few things, we can say the practitioner gathers sufficient appropriate evidence to be able to draw reasonable conclusions. But the practitioner for limited assurance will gather the sufficient appropriate evidence to be able to draw limited conclusions. The procedures performed are very thorough, which includes test of controls and substantive procedures. But for limited, fewer procedures, mainly inquiries, asking the client about why the things are the way they are, and analytical procedures. Analytical procedures basically involve, recalculating and all those things. Concludes that the subject matter conforms in all material respects with identified suitable criteria. So, what does conform mean? Conform means that it is in line with the suitable criteria. So, in the case of financial statement, it would be our financial reporting framework such as GAAP, IFRS, IAS, etc. In the limited assurance, it is plausible in the circumstances, which means that it is correct as per the substantive, as per the circumstances itself. They won't deeply test them, but when concluding on the subject matter, they will tell that it is true and fair as per the circumstances presented in front of us. So the level of assurance is not that great in the limited assurance engagement. It is moderate or lower level of assurance, and it gives a negatively worded conclusion. So what it means by negatively uh, concluding is that if there is nothing that has come to our attention that causes us to believe that the financial statements of so and so are not prepared in all material respects in accordance with an applicable financial reporting framework. So this basically means that they will only comment on those things if something has come up. If everything is good, they will negatively word it, saying that nothing has come to our attention. But in the case of this reasonable assurance, it is positively worded. High level of assurance is there as the extent of procedures is more. So, for example, in our opinion, the financial statements give a true and fair view of the financial position of so and so for its financial performance and cash flows, and it is in accordance with the IFRS. So, as you can see, you would place more reliance on a reasonable assurance engagement rather than a limited one, and that's how you segregate between the two. So, the main thing to note here is that the assurance engagements are never absolute. No auditor will give an absolute assurance over the financial statements or any other subject matter. because there is a chance that even after performing the substantive procedures, doing the test of controls, there is a chance that something or the other could be incorrect. So the purpose of audit is to not correct each and everything. It is to ensure that the numbers are not materially misstated. What do we mean by materially misstated? So they shouldn't be that wrong that your financial statements become useless, right? So there are levels within which if your numbers are slightly off, then it's still acceptable. For larger companies, that number would be higher. For smaller, it would be lower. We will be looking at materiality and misstatements later as we progress. Then we have external audit engagements. External audit is basically what an external auditor, does, gives these assurance engagements. External audit is an example of reasonable assurance engagement. Limited assurance is usually done by, internal audit. So what is the purpose of an external audit? It is to give reasonable assurance. So once there is reasonable assurance, we enhance the degree of confidence intended users can place in the financial statements. This is an important line. So because of external audit, the degree of confidence which you can place, you can be more confident about those financial statements which have been externally audited because they have done the necessary testing and procedures to test those balances and numbers. So you can place your confidence in them and make your economic decisions. How do they enhance the degree? They will give an opinion on these financial statements, whether they give a true and fair view and are prepared in all material respects with an applicable financial reporting framework. So for the AA paper, we will come across things such as ISAs, which is International Standards on Auditing. There are quite a few with numbers such as ISA 200, overall objectives of the independent auditor and conduct of an audit in accordance with international standards on auditing. So you don't have to memorize them. For example, in the financial reporting paper, these were slightly easier to remember. For example, IFRS 13, which is fair value measurement. But here, these are full sentences. So you don't have to remember them. There are no additional marks. ACCA does not test your memory, it tests your conceptual clarity. And it doesn't matter if you remember what ISA 200 stands for as long as you are correct in listing out the things it is intended for, then that's all they are worried about. So we are concerned with what true and fair means. True means factually correct information which conforms with accounting standards and relevant legislation and agrees with the underlying records, which means, let's say, the invoices tie back to the revenue figure. So that means the figures are true. Fair means that they are clear, impartial, unbiased information which reflects the commercial substance of the transactions of the entity. Let's say, for an example, there is a possibility that a certain transaction can be shown in a different way, but that different way would boost the entity's numbers and results. But that is not quite the right way. The right way would suppress the results a little. So it is important to check for us as auditors that whether this has been represented in that correct and right manner that it should have been, instead of showing it in an partial and manipulative way. it should represent the commercial activities, the true substance of the transaction. It should not show it in a way for which it doesn't stand for. So that's what true and fair basically means. You'll be hearing it a lot. So we have the objectives of the auditor. The auditor has to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. Express an opinion on whether the FS are prepared in all material respects in accordance with an applicable financial reporting framework. So why do we need external audit? So similarly, like I said before, shareholders provide the finance for a company and may or may not be involved in the day-to-day running of the company. Directors manage the company on behalf of shareholders in order to achieve the objectives of that company. So the directors must prepare financial statements to provide information and performance to financial financial position to the shareholders. So shareholders are basically the ultimate owners of the business, and directors are the ones who have been trusted with these resources to run the business. But if these directors, act in the interests of their own self-interest, then they have incentives to manipulate the financial statements and, make their own money instead of, doing good to the company itself. So that's why the shareholders need, certain confidence that, okay, the numbers provided by management are correct and they can be relied upon. And that's where the external audit function comes in. And that's why they express their opinion whether the FS give true and fair view. So in most developed countries, publicly quoted companies and large companies are required by law to produce annual FS and have them audited by an external auditor. So if you are a publicly listed company on the stock market or very large companies, then by law itself you are required to, get yourself audited so that the shareholders and other stakeholders can place confidence in your financial statements. Otherwise, there is incentive for the management to just show anything and, fool the shareholders. Those ones which are not required by law to have statutory audit, which basically means external audit only, may choose to have them audited because this would, increase the confidence that shareholders and other influential stakeholders can place. It can be as a benefit of an audit that, you will be seen more of a compliant company rather than a non-complying one. Then we have various benefits of audit. This you can, just memorize this acronym such as HIRED, which means higher quality information, which is more reliable, improving the reputation of the market. So basically, if your financial statements are audited, the information that the company is providing now is of a higher quality. Then we have independent scrutiny and verification, which keeps the management in check and they are not acting out of their own self-interests. Then this also reduces the risk of management bias and fraud and error by acting as a deterrent. An audit may also detect bias, fraud, and error. So basically, just like I referred to the example before, if there is an audit function in place, the incentive for management to, defraud and make errors reduces a lot. Then it also enhances the credibility of financial statements for tax authorities or lenders. The tax authorities will believe that yes, you have paid that amount of tax. Then after that, we have deficiencies in the internal control system, which may be highlighted by the auditor. There are things which may have missed out by the management, but it can be picked up by the auditor, and the functions and the controls could be improved based on the auditor's findings. So these are the few benefits of an audit. But however, there are certain drawbacks as well. We have the expectation gap. Some users incorrectly believe that an audit provides absolute assurance, like I referred earlier, that the audit opinion is a guarantee that the financial statements are correct. This other misconceptions about the role are referred to as the expectation gap. So this basically says that you, just because the financial statements are audited, you believe that the auditor has guaranteed you that there will be no error or anything like that in the FS. But that's not the case. The auditor has not provided an absolute assurance. It's just a reasonable assurance that yes, based on their procedures and their testing, the financial statements are true and fair, and they are not materially misstated. What are the examples of the expectation gap? Belief that the auditor tests all transactions and balances. This is not the case. Tests are performed on a sample basis. It's not possible to test all the transactions and balances. The audit could take 5 years for such, large companies. A belief that the auditor will detect all fraud. The auditor is required to provide reasonable assurance that the financial statements are free from material misstatement, which may be caused by fraud. So the auditor is not telling you that no, there is no fraud in these financial statements. He's saying that the financial statements are free from material misstatement, which may be caused by fraud. So what do we mean by material misstatement? We'll be looking at it later, and you'll have a more clear picture of what it means to say. Then there is also a belief that the auditor is responsible for preparing the FS. This is the biggest expectation gap, that the auditor is not the one preparing the FS. It is the company, it is the management that is preparing the FS, and the auditor is simply, you know, checking it and auditing it, to put it in simple words. If the auditor himself was to prepare it, then what is the point of them auditing it? Then we have a few limitations of the audit. You can remember them by the acronym of FIRED, FIRED. We have financial statements include subjective estimates and other judgmental matters. So, for example, there are a lot of flexibilities and options which can be used to present a certain, balance, for example, let's say. So, at those times, it becomes difficult for the audit to be performed, as the management has used their subjective judgment, and it's difficult to audit judgment, right? So that's a limitation. Then we have internal controls. Suppose you rely on those internal controls, but there is a high chance that those internal controls have their own limitations. For example, you say that the payment of more than 100 million needs to be authorized by the CFO, but what if the CFO is on a leave for a lot of days? Then the internal control is there, but it has a limitation that there is nothing in place when the CFO is on leave. So that is something which is an inherent limitation of an internal control. Then we have representations from managements may have to be relied upon as the only source of evidence in some areas. So in audit, we believe that externally generated information is more useful and reliable. So for example, let's say I am auditing SBI Bank, and let's say I'm auditing Reliance, and I approach SBI for the bank balance of Reliance in their bank. So the statement that I get from SBI I can place more reliance on that bank statement rather than the statement that Reliance provides me. But there are cases, let's say management refuses for us to reach out to SBI. So then what Reliance provides us, we would have to use that itself. And if we are using what they have provided, then there is a chance that it's not correct. It could simply be incorrect, and what we are auditing later on, it will follow the same structure, To test the financial statements, we need information, and if that information itself is wrong, then we will give an, inappropriate opinion simply because we tested what we were provided with. Then evidence is often persuasive but not conclusive. So, yeah, this is similar in that way. So, what we are provided with persuades our audit in that direction rather than, concluding it that yes, this is the way it should be. The evidence gives us a way to reach to the point where management wants us. So, that is a limitation of an audit. And again, it does not test all transaction and balances, only a sample are tested. Auditor provides reasonable assurance, not absolute. It is not possible to provide 100% guarantee of accuracy. So, looking at the limitations, you can read them on your own. It's nothing much. It's same management judgment. Information provided by the client may already be falsified. So, the financial statements will also, in turn be falsified, and we cannot find out. We may not even find out about it. And, relevance of information. This is something which is a good point. So, for example, if you spend too long auditing, let's say if your year end was 31st December 2024, and you audit each and everything properly, with the view to give a very good report and a strong report that yes, we tested all of these things, we performed so substantive procedures, and we and this is our audit report. But this report comes out by 31st December 2026. What is the use of that report? 2 years have passed since the year end. The shareholders which were going to use that information have moved on. They were not waiting idle for your report for so long. So timely completion of audit is also very crucial. So here we have the review engagement, which is an example of a limited assurance engagement. It's similar where it's not required by law. It could be voluntary, chosen by the company. We perform simple analytical procedures. We make inquiries, and the negative assurance report is given, which is negatively worded and says that nothing has come to our attention and like that. So, what is the purpose? It's not legally required, then why do it? It could choose to have a review, then it will provide assurance and it costs less and it is less disruptive than an audit. What does it mean here? So you have to pay fees to the auditor for performing, full stat audit. That fees will be lower for a review engagement and the disruption that is caused by external audit. Uh, Whether we accept it or not, the it is a fact that no one likes stat auditors at the company. They have to the auditors, make inquiries, they ask questions a lot, and for the company's employees, they are distracted from doing their daily operations and they are left with answering the stat auditors. So that is a time which is devoted to answering auditors rather than working their business itself, if you know what I mean. So as my job, it's to question the employees at the client, but for the employees, their direct output is not being achieved by answering to us. Their direct output will be achieved by doing what their work is. So, for example, if an employee at Geo is answering to the auditor, but he should instead be working to improve his, let's say, internet connectivity. So the time he's answering me is going away from improving that operation of the business he's responsible for. So that's how a stat audit is disruptive for the business. It takes up resources and time. So for a review engagement, it mostly focuses on analytical procedures and inquiries. We will have a look at analytical later on. No tests of controls will be performed because the scope is quite less. Work does not need to be as depth as for an audit. Objective is to perform primarily inquiry and analytical procedures to enable the practitioner to conclude whether anything has come to their attention that causes them to believe that the FS are not prepared in all material respects in accordance with the applicable financial reporting framework. So basically, the negative worldly report. So here it's the similar point from above that there is a separation of ownership and control. So who are the owners of the business? It's the shareholders who own the shares and everything. And who is in control? Let's say I have a share of Reliance, but I'm not the one controlling. I am an owner. Let's forget about the percentage. It doesn't really mean much compared to Mukesh Ambani, but still, I could be a 0.00001% owner, but I am an owner nonetheless. But am I in control of the daily operations? No, I'm not. Who is in control? It's the management of Reliance. They are in control. But my money is at stake and the directors are controlling it. So I will need confidence, right? That they are in a good position to use my funds because it's my hard-earned money. No one likes to lose it. So that's why there should be clear distinction, and the directors are responsible for safeguarding the assets of the owners, meaning the directors should act in the best interests of the shareholders, not for themselves, not for their family, not for their friends, but for the shareholder. Any decision they make should be in the best interests of the shareholders. So this is basically what is written here. If we read it from this is a slide information about, incorporating the business as in a limited liability partnership or a limited company, etc., etc. So when you protect, let's say the shareholders seek to maximize their wealth through increasing the value of their shareholding. This is driven by the profitability of the company. Directors also want to maximize their wealth. At the end of the day, who doesn't like money? But if they give themselves higher salaries, higher bonuses, and other benefits, then this will reduce the company's profitability and this will not be in the best interest of the shareholder, right? So there is, a trade-off between the director and the shareholder sometimes, and that is referred to as the separation of ownership and control. We have the agency issue. This is usually called as the agency issue. Simply, this is that as well. Accountability means that directors are accountable for their actions. They are there in a position where they can use the public's funds, but they have to be accountable and responsible for it. We will be looking more about these things later. Agency is when, you appoint an agent to perform tasks on your behalf. So that is where the shareholder appoints the director as their agent. to maximize their wealth. But if the agent acts in their own self-interest rather than acting in the interest of the person who appointed them as an agent, then that's an agency issue. Stewardship is basically, means steward. Steward is the security guard, if you watch a match of cricket or football in UK or something like that, you will see those security guards in front of people and they have steward written on their bibs. So what that basically means is that they are the security. They have that security responsibility that they have to maintain the decorum and the thing of the stadium itself. So similarly, the directors are in a position and they have to maintain security and be responsible for their funds of the shareholders. This is also called as the fiduciary relationship, where the relationship of good faith has to be shown. Directors must make decisions in the interest of shareholders rather than in their own selfish personal interests. Therefore, directors are those stewards. Shareholder is the principal employing the directors, that is the agent. Then the directors are accountable to the shareholders for the way in which they run the company. So basically, what it means is shareholder is the principal, he appoints the directors, director runs the business, then whatever the director has done, he is answerable and accountable to the shareholders. He has to act in the best interests of the shareholders and not himself. There have been multiple real world cases where these directors act in the interests of their own benefits, and that is where it is a recipe for disaster. You could call Satyam, Enron, anything like that. You can read about it more. So what happened with Satyam was that they manipulated the financial statements and all so much that I think the amount came up to 7,000 crores or something, and the share price fell by 80% in a single day and wiped out investor wealth completely, just because the persons in charge were like that. They had the incentive and they had the motive to defraud the company. They showed, they manipulated the numbers, they pocketed things here and there, and it was a disaster. You can read more about such of these cases. It will be interesting for you and highlight why audit has become so important in this modern day and age. Then we have different stakeholder groups who could be concerned with the financial statements. First of all, most importantly, we have the shareholders. Then we have the employees. You know, if they see that the directors are being paid huge bonuses and their salaries have stayed the same for the last 5 years, then they could, take certain decisions and they would want something to be done differently. So employees would also be interested. Then those charged with governance. This is basically referred to as TCWG in short form later on. So they are responsible for seeing, how the structure of the management is, how the board of directors is set, if there are any changes needed to be made. Then we have customers. Let's say the customer is reliant on you for purchasing that one product. And if you were to go out of business and it seems that you are going to go out of business, then that customer may not be able to get that one product anymore from you. So he would need to arrange it from elsewhere. And that's why he would be interested in the financial statements to see whether there is continuity and they are in a safe position. Similar way with suppliers and lenders to check the credit worthiness, and the government would be concerned with the tax, laws, regulations, etc. So we have a few questions which will do, after which our first demo lecture will be done and it will cover our first chapter. So here we have list and explain the elements of an assurance engagement. I think there is a hint here. 5 marks for 5 elements. I'll give you a moment or two to recollect. Even if you don't, it's completely fine. If you think about it in a step-by-step manner, you'll figure it out what it is. So first of all, we had the three parties, which is the practitioner, intended user, responsible party. This is the first element. These are not three elements. Then we have the appropriate subject matter. So what it is that you're assuring over. So that becomes the subject matter. Then we have suitable criteria. What it is against which you're assuring it, the benchmark. So the benchmark is the suitable criteria, which could be financial reporting framework. Then after that, it is the sufficient appropriate evidence. So you need evidence to provide an opinion. You can't do it without that. So, and after which is the opinion itself. So this was your 5 elements. Don't worry, you won't have questions like these, but it's good to remember and know what all things are required. We have your second question as explain the term limited assurance in the context of an examination of a company's cash flow forecast and explain how this differs from the assurance provided by an external audit. I think we discussed this as well in depth that limited assurance gives a negatively worded opinion. It doesn't perform procedures and testing as in depth as an external audit does. And yeah, that's basically the summary of it. The thing about audit itself is that you can, spend a lot of time when studying on the question itself. But there's no point in doing that. Once you have read this question, thought about the gist of it, then you can simply go to the answer and you'll can learn from there itself. You don't need to spend a lot of time trying to get it right the first time. Don't try to get it right the first time you are learning. You can go wrong, it's completely fine, but you have to learn from the answers itself. It's not the school days where you just keep trying until you get it right and then, get that sense of achievement, yes, that I got it right without looking at the answer, because that's not how it is, how it works. It's not efficient. So let's say looking at the answer here, limited assurance and how it is different from an external audit. Low level of assurance, high level, it is plausible. The FS conform with the material respects. It gives a negatively worded conclusion. It's a positive one. Here, limited procedures are performed. More evidence will be needed. Forecast, as I said, relates to the future, inherently uncertain. It would not be possible to obtain an assurance that is free from material misstatement. Fine, FS are historic, so the auditor should be able to obtain sufficient and appropriate evidence. For example, this point was not there up in the chapter itself, but it is something which is there in the answer. So instead of, thinking that, oh no, this was not there up, how can I think like this? Will I be able to get to this thought process in the answer in the exam? It doesn't matter. You've seen it here now, you learn it from here itself. Here we have the last TYUs. So this is how your exam MCQ will look like. There will be a small, case, and there will be 5 questions of 2 marks each. related to it. So I'll do this one for now. You can take a moment to read it. So after having read the case study, let's solve these answers. So we looked that the level of assurance cannot be absolute. So this is definitely not the right answer. It would either be reasonable or limited. And as this is going to be a full audit, it would be reasonable and not a review engagement. Then we have which of the following is not one of the five elements of an assurance engagement. As we looked up, subject matter was one, suitable criteria was one, the written report was one, but there was nothing of assurance file. Which of the following is not a benefit? So, increased credibility is a benefit, deficiencies identified is a benefit, fraud may be detected is a benefit, and sampling is used is not a benefit as such. It's kind of a limitation because full population is not being tested. Then which is false? This is true. This is true as well. May not detect all fraud is true as well. Then the answer we are left with is C. So a good tactic for MCQs, as you may be aware, is the elimination tactic. So let's say I read all these options. I was able to figure out that this is true, this is true, this is true. So I'm just left with C and I don't even have to think about anything else and I can simply mark it C. And after reading it, you get a certainty that yes, this is the right answer. A negative audit opinion will not be given. The audit opinion is in different forms. It's qualified, unqualified. A negative audit opinion is also given where there is no material misstatement found, if you remember correctly. Negative worded opinion, nothing has come to our light. So that also means that the audit opinion is still unqualified only, that there are no misstatements, but it is negatively worded. So that's a trick point. Then which of the following are examples of expectation gap? One is the expectation gap. So if you see 2 and 3 option will be eliminated as 1 is not there. Then 3, the third option is also an expectation gap. So options with 1 and 3 will be the right answer. So I guess only A option has 1 and 3 together. So as we didn't even reach to the unmodified opinion means the company is a going concern part, as this is done later in the chat portion, you could still answer this question by just using the elimination and logics that you can use while answering MCQs. I know that the answer should include 1 and 3. So which of these include 1 and 3? Only one option does. So you are sorted there. Let's check the answers. B, C, D, C, A. B, C, D, C, A. BCDCA. So that's how you can go about it. You have your 10 marks in the bank. That's, 20% of what you need to pass. And yeah, that's about it. So here we are done with our first chapter, the demo lecture. We will be covering the second chapter in our second demo lecture, and looking forward to connecting with you again. Thank you.